Okay, I want you to picture the dashboard of your car for a second. You're on the highway, cruise control is on. You glance down, speed steady, fuel's full, engine temp is normal. That's what a financial market usually looks like. We look for trends, little shifts, maybe a warning light.
Right. A percentage point move in a week is noteworthy. A correction is a headline. It's usually a very controlled environment.
Exactly. But what we have in front of us today, well, the check engine light isn't just blinking.
No.
The engine is on fire, and the speedometer is spinning backwards. We are looking at a snapshot from the GDMAS, that's the Global Digital Market Analysis System. It's dated Wednesday, January 28th, 2026. 1:35 a.m. Pacific.
And to call this volatility is a massive, massive understatement.
It really is.
I've looked at a lot of charts in my career, and this isn't just a bad trading day. Looking at this, it strikes you as a systemic shock. It's a cockpit view of everything: currencies, commodities, crypto, stocks. And usually these things move in a sort of, choreographed dance.
And today?
Today it looks like a bar brawl.
A bar brawl is a perfect way to put it. Our mission for this deep dive is to try and make sense of this chaos. We need to unpack the story these numbers are telling us.
Right.
Because looking at that weekly graph on the left, we are seeing a historic decoupling.
Oh, yeah.
There are lines flying everywhere, but there's one specific line, the red line, that is doing something absolutely terrifying.
That red line is the United States dollar. And if you're listening to this, you need to visualize a chart where a line starts in the middle, wiggles a bit, and then just lets go. It dives deep, deep into negative territory.
We are going to spend some serious time on that red line because it seems to be the anchor, or maybe the sinking anchor for everything else on this screen. It's the catalyst.
Before we get too deep, I do need to point out the disclaimer right at the top of the dashboard. It's standard, but in times like this, it's vital.
Totally.
We do not provide buy or sell signals. This is for educational and informational purposes only. We're analyzing data, a snapshot in time, but we are definitely not giving financial advice.
Absolutely. We're here to read the tea leaves,
Yes.
not tell you what to put in your cup. But man, when the data is screaming this loudly, we have to listen.
We have to.
So let's start with the elephant in the room, or maybe the falling elephant, the US dollar.
Let's do it. So look at the monthly data table, bottom right corner. This is where the raw emotion of the market gets translated into hard numbers.
I see.
If you locate the row labeled USD and slide your eyes over to the percentage column, what's the number you see?
I'm looking right at it. It says negative 21.22%.
Negative 21.22%.
In a single month.
So let that sink in for a second. We aren't talking about some volatile tech stock or a meme coin that rug pulled.
No.
We are talking about the global reserve currency. In foreign exchange, a 1% move is a big deal. A 5% move is a national crisis.
So 21% drop is?
It's a collapse.
Yeah.
That represents a fundamental, almost violent loss of confidence in the currency itself.
And it matches the visual on the weekly graph perfectly. You look at that red line, it's just dragging along the bottom, nearing the negative 80% axis. It's falling off the table.
It is.
But help us contextualize this. What does a 21% drop in the dollar actually mean for, the average person?
It's immediate and it's painful. It means everything you import, electronics, clothes, coffee, just got over 20% more expensive overnight. But more importantly, the purchasing power of your savings has been slashed.
Oh, the money in my bank account.
If you have $10,000 in the bank, numerically it's still 10,000. The app says 10,000. But in terms of what it can buy from the global market, it's now worth roughly 8,000. It's an immediate impoverishment of anyone holding that currency.
That is scary. The number stays the same, but the value just evaporates.
Exactly.
And it's not just the graph. Look at the top right, the weakness and strength meter. You see the DXY, that's the dollar index, right?
Correct. It measures the dollar against a basket of other major currencies, the euro, yen, pound. It's the standard yardstick for dollar health.
And it is the only red bar on that list. It's showing weakness, down another 1.16% just this week.
So this isn't some flash crash that bounced back.
No, it looks like a sustained trend downward.
Exactly. And that is the terrifying part. Usually when a currency drops this fast, you see what we call a dead cat bounce. Speculators buy the dip. We aren't seeing that here. We're seeing continued heavy selling.
So the big question is, if the value of the money is evaporating, where is that value going?
Right. Energy can't be created or destroyed. It just transfers. And on this dashboard, that transfer is violent.
Which brings us to the green line anomaly, or really the green, yellow, and white lines. While the red line tanks, everything else seems to be headed to the moon.
It's a classic flight to safety. But it's also a flight to Well, reality. Look at the standout winner on the monthly board.
It would be XAU, gold.
Gold, up a staggering 55.35% on the monthly view.
55% in 4 weeks. That's unheard of. Gold is supposed to be the boring rock that sits in a vault.
Right. If you had a gold bar under your mattress, it's suddenly worth half again as much as it was a month ago.
But here's where we need to be really precise, because this is where people get tripped up.
Yes.
Is the gold worth more, or is the dollar just worth less?
Ooh. Okay, that is the crucial distinction.
Let's unpack that.
Think of gold as the constant. An ounce of gold buys roughly the same amount of bread today as it did in Roman times. It's the measuring stick.
Right.
If the price of gold in dollars goes up 55%, it doesn't mean gold is suddenly 55% more useful. It means the measuring stick, the dollar, has shrunk. The market is frantically dumping dollars and buying the hardest asset available to preserve their wealth.
It's panic buying.
It is. A 55% move in a physical asset implies panic. It suggests the market has decided that holding paper currency, specifically U.S. paper currency, is a risk they are no longer willing to take.
They want atoms, not promises.
Precisely.
And silver's coming along for the ride too. I see XAG silver up 19.13%.
Which is a very strong move. A 19% month for silver is huge. But notice the lag. Gold is up 55, silver's up 19.
Why the gap? Don't they usually move together, the precious metals basket?
They do, but gold is the primary monetary safe haven. Central banks buy gold. They don't really buy silver reserves. Silver is the industrial cousin. It's used in electronics, solar panels. In a true monetary panic, which this looks like, liquidity flows to the king first.
Gold leads the chart.
Gold leads. Silver is catching a bid because it's hard money, but it's secondary.
Okay, now here is the part that I think will confuse a lot of people, and I want to drill down on this.
Okay.
If the economy is crashing, which you'd assume if the currency is losing a fifth of its value, why are the stock markets green? Look at that weakness and strength meter again. Centio XX50 in Europe up 2.12%, US 500 up 1.92%.
The whole world seems to be up.
Right. If the world is ending, why are stocks up?
This is one of the most dangerous illusions in finance. It's the difference between nominal gains and real gains. And we need to explain this because it traps so many investors.
Please do, because I think the average person opens their brokerage app, sees green, and thinks, great, I'm making money.
Right. Okay, imagine you own a share of a company. The share price goes up 2%. In a normal world, you feel richer.
Sure. Green number means good.
But remember the context. The currency you use to buy groceries, pay rent, and buy that stock has dropped by 21%.
Oh.
So your stock went up 2% in number terms, but the purchasing power of that money has collapsed by over 20%.
So I have more dollars in my account, but those dollars buy significantly less stuff.
Exactly. The stock market isn't necessarily growing because companies are innovating. It's repricing higher because the denominator, the dollar, is shrinking. It takes more weak dollars to buy the same share of stock.
So the green line on the graph representing stocks is soaring upwards, not because business is booming, but because the dollar is busting.
Precisely. The graph shows the green line for stocks and the white line for metals soaring in direct opposition to the red line. It's a mirror image.
As the dollar dives, assets float up.
But if you cash out those stocks into dollars, you've still lost huge amounts of purchasing power. You're losing money in real terms, even if you are making money in nominal terms.
It is a terrifying realization. You could think you're doing okay, even beating the market, while actually getting significantly poorer.
That's called the money illusion, and this dashboard just strips that illusion away.
Okay, speaking of illusions, let's widen the lens to other currencies. Usually when the US dollar sneezes, the world catches a cold.
Right.
But here, it looks like half the world is running a marathon, while the other half is in the ICU.
It really is a tale of two hemispheres. Let's look at the Pacific first. What are you seeing on that monthly column?
I'm looking at the Pacific currencies. NZD New Zealand dollar up 15.66%, AUD Australian dollar up 15.69%. Those are massive moves.
Huge. And remember, Australia and New Zealand are resource-rich economies. Their currencies are often tied to commodities, iron ore, gold, agriculture.
So if the world is scrambling for hard assets, things you can touch, their currencies do well.
That's the logic.
Okay, but here's the anomaly you pointed out before we started. Canada.
Yes, the loonie.
Canada is also a massive resource economy. Oil, minerals, timber. Usually the Canadian dollar moves in lockstep with the Aussie dollar. They're the commodity twins.
Correct. Historically, they move together. But look at CAD on the dashboard.
It is. Ouch. It's down 14.54% for the month. It's crashing right alongside the US dollar.
This is a huge signal. It suggests a regional economic shift.
Yeah.
The market isn't just dumping the US dollar, it's dumping the North American fiat bloc.
So the market isn't distinguishing between the US and Canada based on resources. It's grouping them by geography.
Or economic integration. The two economies are deeply intertwined. If the US dollar collapses, it drags the Canadian economy down with it, regardless of their oil.
So the market is treating both the Canadian and US dollar as toxic while flooding into oceanic currencies.
Exactly. The divergence between AUD, up 15%, and CAD, down 14%, is a 30% spread. That tells me the market sees a systemic risk specifically located in North America.
That's incredibly specific and incredibly damning, like drawing a red circle around the continent and saying, stay away.
And think about what that means. If you're a Canadian investor relying on your resource economy to save you, this dashboard is a wake-up call.
You're not getting the commodity bump, you're getting the continental drag.
Exactly.
Now, speaking of things that should be going up but aren't, we have to talk about crypto. This is the part that's going to upset some people.
Yeah.
The narrative for a decade has been digital gold. Bitcoin is the hedge against inflation.
The hedge against debasement.
So if the dollar's down 21% and gold is up 55%, then Bitcoin should be on Mars by now.
One would certainly think so. That's the theory.
Yep.
But let's look at the reality check on the board.
BTC USD. Bitcoin priced in dollars. It's up 1.53% on the month.
1.5%.
That is underwhelming.
It's practically a rounding error compared to gold. In a month where the physical metal exploded 55%, the digital alternative is basically flat.
Yeah, and look at Litecoin, LTC. It's actually down 8.74%.
And Ethereum, ETH, is up just 1.15%. So the entire crypto sector is lagging massively.
Why? This feels like the moment crypto was built for. Why isn't it performing?
To understand that, look at the base and counter metrics for Bitcoin in the bottom right. This is the key.
Good.
We have BTCXAU and BTCXAG. That's Bitcoin priced in gold and Bitcoin priced in silver.
I see them. BTCXAU is down 14.70%, and BTCXAG, wow, down 34.59%.
This is the critical insight. Bitcoin is losing value against gold. It's losing massive value against silver. In this specific crisis, the market is voting with its wallet.
And it is choosing physical atoms over digital bits.
It seems so. When the system really starts to shake, investors are retreating to the oldest form of safety.
There's a concept in finance, beta, right? High risk, high reward.
Exactly. Bitcoin often acts like a tech stock, a risk asset. Gold is a risk-off asset. This dashboard tells us fear is driving the market.
So when people are truly afraid, they don't want a private key on a USB drive that relies on the internet and power grid.
They want the coal-heavy bar they can hold in their hand.
You can actually see that on the graph, the purple line. That's Bitcoin. It had a massive dip, huge volatility, then recovered to be flat.
Exactly. Now compare that to the white line for gold. It just went up and to the right. Smooth, consistent, powerful. In a crisis, volatility is your enemy. Bitcoin showed volatility. Gold showed strength.
That blows a hole in the store of value theory, at least for this scenario.
It does. It doesn't mean crypto is dead, not at all, but it means in this type of currency collapse, it hasn't yet achieved safe haven status.
Okay, one more sector we can't ignore and it affects everyone. Oil.
Can't ignore energy.
I'm looking at BRN Brent crude up 9.31%, and WTI up 8.71%.
So energy is getting almost 10% more expensive in a month where your currency lost 20% of its value.
That is a double whammy for the consumer. The worst of both worlds.
It's stagflation on steroids. Your money is worth less, and the gas to get to work costs more. And rising oil prices put pressure on everything else. Food, transport, manufacturing. It just feeds the inflation loop.
It's why the stock market rise is so deceptive. So if we step back and summarize this, the strength and strength bars. The strongest assets are
They're real things.
Gold, companies represented by the stock indices. Oil.
Tangible value.
And the weakest assets are North American paper money, USD and CAD, and, surprisingly, Litecoin.
It creates a matrix of value. The market is effectively saying, we trust things we can use, things we can hold, and companies that make things. We do not trust the government's promise to pay.
And we are skeptical of the digital alternative right now.
That's it. It's a hard reset to the basics. When the financial system shakes this violently, speculation dies. Survival takes over.
I just want to go back to that visual of the red line one more time before we wrap. Visually, on the weekly graph, it crosses below everything else.
It's almost poetic.
The currency that underpins the global financial system is literally the floor that fell out.
And notice a crossover point. The green line for stocks and the white line for gold crossed above the zero line right as the red line crossed below it. It's a perfect decoupling. The system is splitting in two.
It really makes you wonder what the end game of a chart like this is. Does the red line just keep going down forever?
Well, historically, when a currency moves 20% in a month, policymakers intervene. They raise interest rates, implement capital controls. But looking at this dashboard, the momentum is severe. This isn't just a correction. It looks like a repricing of the American economy on the global stage.
A repricing of the American economy. That is heavy.
It is. And for you, the listener, this brings us back to, what does this all mean for me?
Yeah, let's bring it home. We've seen the flashing lights, the crashing lines. What's the takeaway?
The takeaway is you cannot trust the nominal number. If you open your brokerage app and see green, do not celebrate until you check the currency value. In a world like this, your goal isn't making money in dollars. Your goal is preserving purchasing power.
Because if you made 5% in stocks, but the dollar lost 21%, you actually lost 16%.
You're losing the race. You are running backwards on a treadmill that's speeding up. The only people moving forward are holding the assets that are repricing real value. Gold, commodities, maybe select foreign currencies.
You need to anchor yourself to things that are real, not things that can be printed.
That's it. It's a sobering reality check.
It really is. The dashboard looks futuristic, but the story it tells is one of significant upheaval, a financial storm.
And in a storm, you don't worry about how fast your boat is going. You worry about whether it's going to sink.
Well, on that cheerful note. But seriously, this has been an incredible look into a very volatile moment in time.
Absolutely. It shows the importance of data over narrative. The narrative says Bitcoin is gold, but the data says gold is gold.
The narrative says stocks are up, but the data says dollars are down.
Exactly.
We've covered the crash in the red line, the explosion of metals, the deceptive rise of stocks, and crypto's failure to launch. So here's a final thought for you to chew on. In a financial environment where gold is up 55% and Bitcoin is basically flat, is the future of finance actually just a return to the past?
That is the big question.
The numbers suggest the market trusts gold bars more than blockchains or banknotes right now. Maybe the oldest money is still the best money.
It might just be.
Thanks for diving in with us. Keep your eyes on the charts, watch that red line, and we'll catch you next time.
Stay safe out there.